It's 6:47, and this week both Nationwide and Santander have announced a price hike for their mortgage rates. This is the bad news for new borrowers. Steph has got much more on this to explain.
Yes, good morning to you both. Not great news if you're looking to buy a house at the moment. Good morning, everyone. Yes, it wasn't that long ago that the Treasury and the Bank of England decided to pump £80 billion into the financial system to try and loosen up the lending. But so far, it doesn't seem to be getting any cheaper to get a loan. Now, all the different lenders out there at the moment, there are a number of them who've announced rises to their mortgage rates since the spring, which has been affecting hundreds of thousands of homeowners. The average two-year tracker mortgage, that's designed to track the Bank of England base rate of just 0.5%, has gone up from 3.27% to 3.87% in the last year. So that's been going up despite the fact that that bank base rate I mentioned of 0.5% hasn't changed. Well, joining me now to explain all this is Charlie Cunningham, Chief Executive of FreshStart Living. Good morning to you, Charlie.
Good morning, Steph.
Why has it been getting more expensive even though the base rate it's meant to track hasn't changed?
Because the base rate doesn't necessarily correlate with the amount of with the interest that the banks are paying when they borrow money. It's been a difficult time globally for the banks, and particularly with the issues in the Eurozone, the actual cost for them to borrow money has gone up. So although the base rates are very low and the government's doing what it can to lend money to the banks at a lower rate, the overall cost of borrowing for the banks is still fairly high.
And it's still quite difficult to get a mortgage in the first place. The terms of mortgages and the deposit you need is still quite high.
Absolutely. I mean, the Halifax put out a report on Monday this week saying it's the easiest time for 15 years to borrow money, and it's the most affordable time. That's true if you've got a 30% deposit to buy a house or a flat with. It's not true if you've scraped together 10% and you're trying to borrow money for the other 90%. The rates are still very, very high.
So what are your other options then?
Other options, well, the obvious option is to rent. And I wouldn't say that's a bad idea at the moment, given that some economists are saying that property prices are going to fall by 10% over the next couple of years. If you put down a 10% deposit, you pay a huge amount of rent, you pay a huge mortgage rate, and you have to pay for the upkeep of the property. That's one alternative. The other alternatives that are out there are shared buying schemes, whereby the local authority or a housing association owns part of the property and you own the other part. But that's quite a dangerous thing to get into, particularly if your circumstances change and you need to move out for whatever reason. You then may not be allowed to let the property to somebody else, and you find yourself stuck in a property that you can't live in anymore.
And also, you mentioned renting. The other danger with that is rent. We've seen rental rates increase as well, so it becomes more difficult to pay for that too.
I mean, the long-term solution is more property in central locations, rebuilding, getting money back into the building industry in order to build in central locations. I'm not talking about covering greenbelt land with new houses. I'm talking about central locations, building affordable property, and local governments and the central government working with developers in order to be able to provide that.
OK, well, thank you very much for your time this morning. I'll be back a bit later, but for now, back to you.
Look forward to it, Steph. Thanks very much.